Welcome to KNN. KNN is brought to you by Bob Knakal, Chairman of New York Investment Sales at JLL.
Hi, I'm Jon Hageman, Managing Director at JLL. Welcome to KNN. Today I'm here with Bob Knakal, Chairman of New York Investment Sales, and today we're going to talk about the 2020 investment sales forecast. So Bob, in our last episode, we talked about the year-end summary investment sales numbers for 2019. Today we're going to talk about the forecast. Tell us what we're expecting to see in 2020.
Hags, you have to look at the big picture, the macro picture, to kind of put into perspective where we are currently, where we may be going. As we've discussed, we are in January of 2020 now, meaning that we're 52 months into a correcting market in the New York City investment sales market. That is something that is new territory for us. The longest correction that we've seen previously was during the S&L crisis in the early 90s. That correction lasted 48 or 49 months. So we are in uncharted territory, but we do think that the tide is turning based upon what we're seeing in the market today.
Bob, we know the fourth quarter statistics in particular were a bright spot for the market last year. What are some of the reasons you think that was the case, and leading into this year, what do we expect?
Well, we saw a great $9.5 billion of sales volume in the over $10 million sale category in Manhattan last year. That was a very, very optimistic and positive sign for the market. I think a lot of why that's happening is that there's a lot of pent-up selling demand in the market. As is the case at the beginning of any correction, value is a little more sticky and volume tends to fall off the table as potential sellers are unable to get their price, so they decide not to sell. Those that do get their price do sell, and you have this dynamic where value stays sticky, volume falls off. We've had this volume declining for a long, long period of time, over 4 years, but I think that some of those sellers have gotten tired of holding on. They've decided to pull the trigger and sell. Low interest rates have been helping that dynamic quite a bit, allowing buyers to maybe put a couple of extra dollars on the table. So the expectation is that going into the 2020 and further this year is that there will be more trading. We see the supply of available properties is picking up quite a bit. There are different sectors of the market are behaving very differently. But all in all, we believe that there will be higher dollar volume this year. There will be a higher number of properties sold this year than last. And so from a volume perspective, we expect things to be very, very strong.
Bob, you specifically just talked about volume, but what about value? What do you think we're going to see in 2020 compared to 2019?
Values are interesting, Hags. I think that there's some price discovery going on in some sectors. And I think different product types are going to react very differently. It's really, it's a market unlike we've ever seen in that different product types and different subsectors within the product types are behaving differently. Geography has a lot to do with how different sectors are performing. But generally, I think we see a lot of strength in the office sector. Office fundamentals are doing well. Leasing volume is good. Generally, there's a very positive perspective on office. The industrial market is another one that is doing really well. The vacancy rate in the industrial sector in New York City is at about 3.5%. Lower in Brooklyn and in the Bronx, the vacancy is less than 1.5%. So the industrial market is doing very well. We're seeing industrial rents increasing, so we'll likely see an increase in the price per square foot of industrial properties. Those two sectors are doing really well.
That's industrial and office. What about retail?
Retail market, I think we're going to see some positive change in. If you look at where we are on a rent level basis, rents have, we think, kind of found their footing, found the bottom. We expect that there could be some positive trends in retail moving forward. Certainly based on the disruption that we've seen in the multifamily market, we've seen a lot of traditional multifamily buyers that have been looking to not buy multifamily anymore, but transition to buying office. They're also looking at the retail space, so there may be more buyers for retail than we've seen in the past. We're handling some retail assets now that we're getting some very strong activity on and some new interest. So I think that's very positive for the retail market.
Bob, you mentioned some disruption in multifamily, obviously what happened in June of 2019. What's your expectation for 2020 as a result?
Multifamily market is going to be highly dependent upon what happens with the next legislative session. There are a lot of proposals that have been discussed in Albany. We're not sure what new legislation is going to come out of the next session, but I think that participants in the multifamily market in New York are anxiously awaiting to see what's going to happen with new regulation. And so that's going to have more of an impact on the market than the underlying fundamentals of the market, actually. We saw a slowdown in multifamily sales last year, not surprising. As I mentioned, a lot of multifamily buyers getting into other sectors, a lot of New York City multifamily buyers going to other cities around the country to buy multifamily assets. That's not something we like to see, but the private sector will go where the incentives move them, and so I think it's incumbent upon our elected officials to think about that when they're making new legislation. But multifamily market, I still think we need another quarter or two to really get a good idea of what the impact on value has been. It's a little opaque right now because we don't have enough data points, but that's going to become more and more clear as we go into 2020.
So all in all, what's the prognosis for 2020?
Hags, I'm optimistic about 2020. I think we're going to see volumes go up, more activity, new buyers coming into the market, and I think that based on the strength of the broader economy and the fact that we've been in this correcting market for so long, at some point it has to change. You know, the cyclicality of the market is a given, and so I'm looking forward to a very robust and strong 2020.